unfiltered opinions.
Introduce me.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
I'm Nicolette Mashile.
And I'm Simon Brown.
Welcome to Insider Exchange.
In Market Matters this week, we take a look at the Fed's FOMC decision to leave interest rates unchanged, as well as the comments from Fed Chair Jerome Powell and what that means or what that could potentially mean for the rest of the world. Then we look at Quantum Foods. It seems they can't get over all of their drama. There's a lot of drama happening there. And then we look at Discovery. They've decided to abandon Pick and Pay. How dare they?
Everyone's abandoned Pick and Pay.
Except Sean.
Except Sean.
Let's start with Powell. The US sneezes, the world gets a cold. We're tired of this narrative, but it's still playing out.
Yeah, it absolutely is. Although interesting, I mean, the question was, and I on my show asked a couple of folks, like, can the rest of the world cut before the US? And the
Europe did.
Well, that was it. Europe did. Bank of England did. Canada. Okay, Canada.
Canada. No one counts Canada.
But suddenly everyone's like, oh, guys, we can't wait anymore. And there's small cuts and everything. But it's always the press conference afterwards, right? Which she gives half an hour after the results, after the announcement. And the press conference, and I quote, policy rate could be on the table as soon as the next meeting in September. Now, okay, could be. But I mean, short answer is they're going to cut in September. There's no, unless we see unemployment suddenly at 3.5 instead of 4.1, unless we suddenly see inflation spiking. And I don't see that happening anywhere. You know, oil is coming down. I mean, I don't see anything to stand between them. That meeting is 17, 18 September, announcement on the 18th. To my question is, the debate now is, how big is that September cut?
Right.
25 or 50? I think 25 because he's got November and December.
I think he's conservative. He's never going to go shock the market, do a 50 basis point cut. He's going to say, look, we'll do 25. We'll see how it goes. Yeah. We'll review the situation. We'll monitor it. Yeah. And
he can keep, I mean, he's got 50 and 100. You know what? And if you get behind the curve when inflation is rising, you're in trouble. If you get behind the curve when inflation is falling, you're less trouble.
I mean, it's always one of those. So you can do a 25 basis point cut in September. You can do one in October. And then if the situation is dire in November, you just do a 100 basis points, full 1%.
Yeah, so I think there isn't October. I think it's September, November, December are their meetings. And then, of course, our MPC.
Oh, wait, October's Jackson Hole. No.
October's something, but it's not a FOMC. And then I own MPC is the day after their September power meeting.
Ooh.
And again, I can't see in which world our good governor doesn't cut. And let's be clear, at the last meeting it was 3-2. 3 no cuts, 2 cuts.
It was basically there.
We have to swing one person. Now, if you tell us who that person is, we'll send flowers, chocolates, whiskey, I don't know. You tell us your poison, we will send it. But I just can't see. So, I mean, I think it's like, now let's be clear. Coming into this year, we were told 6 rate cuts from the FOMC.
7 at some point.
7? Yeah, okay. We've been lied to before, but this time it feels real. It feels right there.
Oh, no, Jackson Hole is this month. Sorry, Jackson Hole is the end of this month, 24th to 26th of August. But nonetheless, the Fed conversation, I think, for as long as the dollar has been the lead currency, this is kind of why we've had to take the cue from there. But economies are seeing that even if that is the case, you'd rather risk it for a 1 or 2% potential movement this way or that way than letting your economy go into a recession.
Yeah.
Because if you wait for too long and your consumer is under too much pressure, then it's a different set of problems you have to deal with. And what did you wait for? For the US to go first?
Yeah, no, 100%. But this Jackson Hole's going to be fun, right? Because the recent Jackson Holes has sort of been around over the last couple of years. Ooh, look, inflation. Haven't seen that in ever and a day.
20 years.
Inflation, I mean, you must remember, at the peaks, inflation were back to 1980s levels. We were at 40-year highs for global inflation.
We were.
And now suddenly, I mean, do we do a victory lap just yet? I mean, if I were a central banker, they're typically grey and boring, so they're probably not. But I would certainly have the champagne in the fridge and definitely cooled and chilled on ice and ready to go.
Well, we'll see how it works out. I think we'll have to wait and see how the US picture pans out, but we're certain we're going to get at least 1, hopefully 3 rate cuts between now and the end of the year. Let's come back to some local news. Quantum, they can't get rid. Oof, I don't even know where their problems start and end.
So let's go all the way back to, it was around March. They had an annual general meeting. They re-elected members to the board. Shortly thereafter, a Ms. Tanya Golden quit the board.
She was the legal professional we spoke about last week.
The only legal professional on the board. She quit. She then turned around and sued the board because she said she had asked for legal opinion on their first decision not to call an emergency meeting as requested by shareholders, and she wasn't given the legal opinion as the only lawyer on the board, and then they told her she must resign. And she is, as I understand, trying to build a career as a non-executive director. And this got elected to the board and left a little while later. It looks bad on your CV. So she needs to clean this up as to what happened here. So that was the first bit of trouble. And then they got a letter from Country Bird, who currently holds around 18%, saying that they want the lead non-executive director and the chair to be gone. And then they appointed a new chair, on a new board member on Tuesday, and on Thursday they got another letter from Country Bird and saying that one there must go too.
That person.
And I have had sight of some of these letters, and they are fiery. The Country Bird is not playing games and not taking prisoners. And they raise issues such as, remuneration considering relative, that return on capital is like, 0, while weighted average cost of capital is like 12 to 15%. The fact that Country Bird has ideas and is constantly being rebuffed when they try and engage the board. The board wants nothing to do with them, etc. The court case from Ms. Golden.
How much of Quantum does Country Bird hold?
It's only 18%. So, and that number's changed, right? Because you remember somebody had a stake and then they sold some to Country Bird, and then Astral was there for a while. Chris Skitter picked up a whole lot. Currently, it's only 18%, which is not even negative control. I mean, they can pass special resolutions without Country Bird, because for that you need 75. So it's not even negative control. But it's 18%. They are people who, they're not listed anymore, so we don't know how well they do. But we know that Quantum is struggling. And if you compare them to Astral, who is the gold standard in chickens in South Africa. So, tough comparison. But hey, if you're not comparing against gold, what are you comparing against? Bronze. I mean, come on. And they raise some serious questions. How come the board's been buying shares at these crazy prices? I mean, the share price has done nothing until suddenly it's announced that there's some dealings happening between the major shareholders and stuff. So I wouldn't want to be on the Quantum Food Holdings board. They probably are safe, because I don't think Country Bird's going to get the 50% necessarily. But I think Country Bird raises some good questions, and Country Bird should have some board seats.
But as Country Bird, at what point do you sit back and say, I'm going to leave Quantum, I'll go buy myself some RCL stock?
Rainbow. Astral,
anything else.
But you know what I think
Rainbow,
they're seeing
not
here?
RCL, yeah,
Yes,
Rainbow.
You know what I think they're seeing here is they are seeing deep valuation when the shares are around the 4 rand, not when it's currently at the 11.01, and certainly not at the plus 18. I think they're just seeing some really deep value, and they're like, and we can help unlock this value. And the board seems to be saying, shares 11, who cares? But the share's not 11 because of earnings and dividends and profits. The share's 11 because the market saw these shareholder changes and thought there's an offer coming. Country Bird has stated on record, we are not making an offer for Quantum.
Speaking of not making offers on things and just walking away from deals, Discovery walking away from Pick and Pay in favor of Checkers and ShopRite.
Yeah, I mean,
that's weird.
And I don't know how this works. Is this a Discovery decision, not a Pick and Pay decision? I imagine it must be, right? This isn't Sean Summers saying, because why wouldn't Sean Summers like the deal?
So you can still spend your Discovery miles or your Discovery earnings or whatever at a Pick and Pay, but now the lead partner on the Vitality side of it is going to be the Checkers business and not the Pick and Pay business.
So you get your money back for your healthy food,
right?
And stuff.
But now look at Checkers' footprint versus Pick and Pay footprint. Look at Checkers' balance sheet. Look at it. It doesn't look like a deal that I think Pick and Pay could have afforded to lose at this stage.
I agree 100%. I mean, I do think, we know that no one's loving Pick and Pay like they used to, just from the customer experience, and that's my own experience. I mean, I've got within 2 minutes of my front door, I've got all of the major
And
food
Pick and Pay is the
retailers.
last one you walk into.
Pick and Pay's last, Spar's second last, and then it's either Checkers or Woolies, and that depends what I want to buy. No, because Woolies love them, but they're not. Their stuff's lacquer, but their stuff ain't cheap. Checkers,
It's
when I
not.
want cheap stuff, and
300
when I
rand for strawberries
yo
at Woolies.
yo.
No, Woolies is overpriced.
Was that
still.
strawberries or strawberry farm? I think it shows two things. I think it shows, ShopRite, like machine. But it also shows a surprising little bit of power that Discovery and most notably their Vitality have. I mean, they wield a bit of an axe. They are going to drive some customers and there are people out there who play these Vitality things, like they keep spreadsheets and stuff.
People show up for that annual check. They want their points. They go and they tick off all the boxes.
Some of those folks are now, come end of August, when Pick and Pay falls away, zip, they're off to Checkers. Just as simple as that. I mean, is it a lot of people? I don't know. But right now, Pick and Pay can't afford to lose one granny, never mind a whole lot of Vitality fiends.
How do you come back from that? How do you take Pick and Pay, right? We've discussed the rights offer. We've discussed what you're doing with Boxer. We've discussed where you want to play in the space. Your Boxer is going to compete with an OK, but your Checkers is a much bigger beast that has a lot more in terms of logistics infrastructure and all of that. You're sitting there, you're Sean Summers, you've done this before, but you don't have another 30 years to do it again.
No, you don't have 30, but you've got 3 to 5, and I think he's on record as saying 3. So you do I think 2 things. The first is you reorg the organization. In other words, you shut down stores. A borderline store, don't try and make it profitable, just close it. Just stop the bleeding, and then get your processes back into place. Your distribution centers, your staffing complements, your stock on the shelves, just good old fashioned grocer. But I think it starts with shrinking because they're not at the place. Maybe 2 years ago, with the previous CEOs, you weren't shrinking. You were trying to sort of fix the boat while growing the boat. That is now past. That
New boat,
smaller boat, and you just start from scratch. And your key thing is you've just got to make it a good customer experience again. For the folks who are older, who remember the 80s, who remember Raymond Ackerman, the savior of the South African consumer, you've got to get back to that again.
but those folks now are older.
Dead.
Those folks have now migrated to a Checkers.
You've got to redo it, and it's
And
hard.
your new folk.
So an example, I mean, so you go to ShopRite, which is their lower LSM. They do a lunch for the blue collar worker, $5 or $10 for lunch. The blue collar worker knows that's a loss. You go to Checkers, they do a lunch for the white collar worker, 35, 45 rand. It's a chicken wrap, it's a coffee, it's etc. Again, I know that is deep value, probably at a loss, and the consumer knows this, and to get that mind share, it didn't happen overnight for ShopRite, and I don't know how Pick and Pay gets that back. I mean, this is almost a fight which you want to call on a technical knockout, which is like, you know what, Pick and Pay, well played, whatever. You know, does Pick and Pay ever take it back to ShopRite? Sure, in enough of a manner that ShopRite notices. H.
Yo, that's a big one. I think that's a very telling statement to say. You can come back. You can try and come back. It might take you a long time, but understand, if we are still looking at a 3 to 5 year turnaround, in that 3 to 5 years, Peter Engelbrecht and his team are not going to be slowing down. They're not going to sit back and say, let's wait for our competitors to catch up.
Do you know what I saw quick, and I really pressed for time, but on the update from ShopRite, what really struck for me, they added 201 net stores, blah, 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 blah. But here, the remaining 63 were Pet Science, added 33 to 86. Checkers Outdoor added 14 to 22. I don't even know what Checkers Outdoor is. Unique added...
The camping business.
Added 13 to 22. And Little Me, again, never heard of it, added 3
That's
to 12.
the baby business. So you're, as Checkers, you can have all of these things as
little testers.
one store, right? Yeah. But you've gone through that model. You've now gone into a model where your pet store is a little store that's adjacent to the Checkers, which is also adjacent to the baby store, which is also adjacent to the
liquor
outdoor
store.
camping store and the liquor store. You can literally walk into a mall and find a wing that is just Checkers stores. How do you compete with a footprint like that?
You can't. And Checkers can throw up 63 new stores as a test, as let's try this spaghetti on the wall type of thing.
It could work, it could not. We don't care either way.
And if we get our pet science is now 86 stores and we decide not, you know what, we shut it down, and you don't even see it on the cash flow statement or the balance sheet.
That pet stuff, we must look into that pet business, because with Woolies buying out Absolute Pets and Checkers going into this pet thing, and it's become the next thing for grocers to say, we now need to accommodate this part of our consumers'
Pets are big.
life.
I know a guy who was buying out vets 20 years ago in the Western Cape because back in the day the vets basically gave cats shots and dogs, and now suddenly they do all the rest. And he was amalgamating like crazy, and has got a very nice little business, a really nice little business of vets.
It's such a weird space. I think that's maybe going to be one of our deep dives, is looking at the value of the pet industry and how to take advantage of that. That's all we have time for this week on Market Matters. In our deep dive this week, we take a look at commodities. It's been a whirlwind across Brent crude, gold, copper, platinum, and everything in between. And we thought, why not bring in a specialist to take a look at some pricing as well? Because the valuations we think are out there in the market might not necessarily align with how the markets are playing out. And we're joined in studio, thankfully, by one of the best technical analysts we both know, myself and Simon included. Moxima Gama joins us. Thank you so much for coming through. Thank you for joining us. What are we starting with?
Because you look at that chart, that's fancy stuff.
No, that's some fancy. I do a line, I do a horizontal line, and I do a trend line, and woo!
Look, there's
a lot here.
You're doing good.
This is what happens when you're an analyst. You've got so many different charts and things, and you've got your levels on one. And the beautiful thing about the software, about the TradingView software, is you can actually save what you've been looking at. And I think that's one of the things I enjoy about it.
We all know gold has just been on one upward trend, right?
Yeah.
And it's just, from the time, I was trying to see if I could put it on the monthly chart, but it will be a bit distorted. But this is the most important part I actually want to show you. So this trend line would then indicate the long-term overall bullish trend. And then when it comes to this, looking at these two trend lines over here, which pose to be quite important in the sense that every time when they breach, they start a new bull phase, right? If I could just, so they start a new bull phase. A new bull phase started there. And as you can see, we've just recently having breached that trend line that's tested more than 3 times. So we're practically in a new bull phase and could start another bull phase once this other trend line. So let me just zoom in to show you. Once this trend line is breached, and you can see we're literally probably just teetering on that trend line. So in other words, what this chart is telling us is we've entered a new bull phase that will become an even steeper bull phase should it break out of this sideways pattern that's in, because it's been trading sideways between 2,485 and 2,280. So above that high, if you calculate how far it will go there, it will then potentially go to 2,690, which is about less than 10% down, about 8%. So that's the potential move that could happen, and it could be quite a steep uptrend to that level.
It looks crazy that you'd think this is sort of an unrealistic number, but I'm looking at, based on where your trend line's sitting at around 2,480-ish or 484, and where we are now, at 2,463, but this could happen
and
closing
especially
out
with,
next week.
The fact that, interest rates were unchanged in the US, but there is that anticipation. We're getting to fourth quarter already, right? It's like, and then there will be a cut, and that bodes well for gold. So that's why probably there's that anticipation of that steep upside towards that level.
Why did gold spend so long in that consolidation kind of space? Anything between, and you can probably say between $2,000 an ounce and 2,400, it kind of went sideways for a long time when there was a lot of uncertainty. And typically when there's uncertainty, safe haven, gold becomes the favor. But this time around, I suppose with the US dollar having its returns or having its returns boosted by the elevated interest rates, gold wasn't as in favor as we thought it would.
No, it wouldn't, because it's better to be in interest-bearing assets, right? If the interest rate is going up, but if they're going to cut, then it means your pocket is going to be cut. And what would you rather get into? And because of that, they're going to be taking money out of interest-bearing into something, so it has to go to either gold or equities. So that's why I think the cut itself will bode well for gold shares as well as equities. So we're just kind of waiting for that, and you can tell with the type of momentum with these rising bottoms forming up there that there's already gradual buying upside, and once it just breaches that, which all-time high is effectively at 2,485. So breaching that is just going to, as I said, showing these these little circles I was drawing, and the trend line is just that. For me, it just gives me an indication of the type of celerity it will be, and if it has. This says from April, it's just been meandering. And now once it gets out of that consolidation, that's when we could just see that rise.
Yeah.
So you just kind of want to be in gold shares of some sort.
No,
or
you
gold
do.
commodity,
And these things, I just looked. So globally, the average all-in sustained cost for gold miners is 1,276. This is an EY report from earlier this year.
1,276.
Yeah, so let's call it 1,300. And in South Africa, it's about that. Although the new Pan-African mine, I think, is coming on at 950. But these guys are making,
they're making 100%.
They make, and if it goes to
1,300 to 2,600, 100%. Call it. Yeah.
They're making 50% gross margins. It is
on
insane.
On the same production. They don't have to increase production.
nothing.
They don't have to adjust their system. Exactly the
Just supply
same
and demand.
production is just higher demand.
Yeah.
That's crazy.
Yeah.
And I just want to point out something it's going to be quite important as well, because I'm looking at the weekly chart on gold, right? And this is pretty much a symmetrical triangle. Once it breaches that, which it hasn't been since April again, that itself is just a call for buyers. It's to push it up. And gold has that tendency to remain in that overbought territory for an extended period. So that's why I'm just like, if you just put a long at 2,485, you're going to be good.
Do you think we'll get a pullback before we move on?
You could be correct in the sense that this particular trend line was curbing a lot of that upside. And if at all that's the case, it will just remain in that sideways band. But you need to keep this level, in some kind of position, because once it is breached, that's when we could see. Because there's two factors. We're kind of waiting for a breakout based on a couple of reasons, and they all are bullish reasons. And
there's no resistance beyond that. This is the last.
That's it. That's why we had to kind of get a calculation from the sideways pattern where it's likely to go.
2,280. I see that's probably the low end of that range, or that consolidation range that it's been sitting in.
Yeah, and with these rising, unless something terribly happens, that 2,280 once breached, that would mark, some downside.
So that's our downside panic level.
That's
Which is unlikely if you think about all the things that are happening out there at the moment. And we're going to jump to the Middle East now. Oil prices, you'd think, would be affected by Middle East tensions, but the OPEC bloc has been very, very clear around controlling that price following, I think it was April of 2020, that crash.
Yeah.
That big oil dip down where futures went negative for the first time in history, and we all freaked out. And I remember at that time, I got so many phone calls from people saying, what do we do? We're holding Sasol. What do we do? And I remember the Sasol share price came down to, I think, 20 Rand or something. I said, buy as much as you can afford to. Buy as much as humanly possible, because the reality is, if 80% of the world still uses fossil fuels, we're not going to disappear from oil overnight, you know? And since then, OPEC was like, we are not going to let this happen.
Sasol's a one-stop shop. It's going to be a one-stop shop soon, so...
Yeah, and that consolidation's been since about April. So
Yeah,
the reporting
April.
season we're seeing from gold miners coming through now, some of it will be at the lower levels depending. But
the next cycle is going to be the 2021 super cycle levels.
Yeah, the 25
where they're
results
paying
coming through are going to be staggering.
Yeah, especially if this continues. Let's jump to oil.
The Brent chart, we'll get to Moxima in a moment, basically tells me two things. A, global growth isn't as smart as we think it is. And B, Russia is selling as much oil as they can to China and India, who are therefore not buying oil from the OPEC majors.
I was just going to say, because in as much as we're seeing this, the China story has always been the driving factor behind it, right? Chinese demand has always been what's driven global markets, movements and everything, because still one of the fastest growing, if not the fastest growing, emerging markets. So if they slow down, then everything else is slowing down. But what you're raising about the Russia thing is interesting, because I remember Prime Minister Modi coming out and saying, I'm going to buy oil from wherever I can get it from.
Yeah.
I'm not going to sanctions for what?
Yeah.
Listen,
And Xi Jinping don't care either. He just wants oil. And Russia.
but when have the Chinese listened to anything the Americans have said?
Yeah, no, they just like do the opposite.
Exactly. They're like, okay, we're going to not do that.
So where does oil go next? Is it going to?
So the thing about this, what the chart is showing me is that it's completely gotten out of its long-term bear trend, as you may see. But also, it quickly, this type of movement, this type of upside is always not sustainable.
Yeah, that was the invasion, right? Yeah, that was February 20. Yeah,
Yes, around
February 22.
which is obviously now fizzled out quite a little, but it hasn't fizzled out to an extent that it's returned back into its bear trend. So it's in this huge, really boring consolidation. If I could just zoom that in. So it's in this huge, boring consolidation. And so is its RSI, where these are the two trend lines that are really curbing either upside or downside movement. But at least you've got these kind of levels that will give you an indication of once it breaks through 92, that's when we could see the target for that. It would actually be at 113, which is the base of that symmetrical triangle. But if it breaks the lower end and trades below 71, it could then return back into its bear trend to 50.
Whoa.
So what I know about oil, from the little I've been listening to the OPEC bloc discuss, $80 is too low for them. They refuse to go below $80 because they don't like that level. The reality is they can price at $1, but they feel that $80 is too low, but the market feels that $100 is too much. So it's this tug of war.
Yeah, it's a tug of war, yeah.
It is, right? They're saying,
And
well...
it's indicative with this particular pattern forming, because symmetrical triangles are a tug of war between,
And the price cuts. I mean, every time you see the price getting to a point where everybody might say, oh, it's too expensive, they're like, no, don't worry, we'll cut prices, or we'll do this, or we'll put more supply in. And it's interesting that a bloc like OPEC can overnight change the landscape. They can have a meeting on a Sunday and say, we're cutting 3, 4, 5, 6 million barrels per day. This is exactly when we will do it. And the market will be like, oh, okay. There's no resistance. There's no feedback. There's no negotiation. There's no discussion. And even with the US, I remember, I think was it last year or towards the end of last year, where the US had thought that the supply they had would be able to offset against the cuts that happened, and that's not the case.
It's just the correlation sometimes just changes all the time. You'll think it's correlated to that, and then all of a sudden it's not. And I guess that's why I enjoy charts, because they will just tell me what it is.
They make sense. They don't listen to Donald Trump. They make sense.
Yeah. So, I mean, like you say, there is that tug of war, but excuse me, we're going to, I don't know, effectively it's out of its bear trend. So there is a potentiality, it could potentially breach the 92. But yeah, the RSI has to follow suit with that. Otherwise, we're just going to be in that sideways band between these two levels until it reaches the apex. So yeah, that's what we should at least be anticipating. And it's huge. It's a huge range at this point. If I took support there, it would be 76. It would range between $76 and what's that high there? And 80. Let's say 88, 76 and 88 is the tightest range band until it actually reaches the apex, where it would have to break upwards or downwards.
How much of this is down to where Chinese demand will start to kick in? Because we are expecting at some point that the Chinese economy might recover, or it might not. But when that does take place, obviously that's going to spur on global demand, and that's going to have a bigger impact there. Are we thinking that until that happens, we could realistically stay inside this channel? We've got no reason. I can't think of a reason to move out.
Yeah. Nothing really, very monotonous sideways band, but out of its bear trend, that is. You know what I'm saying? So yeah, we just have to wait for a breakout at this point. You can't try and outsmart this unless you're sculpting, but yeah.
But also that's it. I look at all I know about oil is it impacts my petrol price, and I don't even use much petrol. So
don't get me started.
Like oil when it's
don't get me started on that conversation. The oil price should not be impacting the petrol price the way it does in South Africa, and that's because at some point we used to have 6 operational refineries. We used to refine our own fuel. We used to import less than 50% of our oil. Last stats I checked, we were importing 80% of our finished petroleum because we closed down our refineries. There's one group of people that is responsible for that. We won't get into that because they now own Petro SA.
Do we even know what the calculation for our petrol
Yeah,
is?
so weirdly, they use the Singaporean
Yes, 40%
benchmark.
of it is levies.
Yeah, so it's levies.
The
and
rest of it doesn't
transport.
matter.
But the benchmark,
That's a huge amount.
the benchmark price is some price point out of Singapore. I don't know why Singapore, but Singapore.
Supposedly neutral?
Well,
I don't know.
It was something because of how they refined their. Anyway.
We'll figure it out. Let's move to copper because that's another
copper.
big thing. Copper's been one of those. EVs, yay, copper. No EVs, boo, copper.
Also, Nvidia chips. Those Nvidia chips.
That's it. Nvidia chip, and then BHP's like, no, we're gonna buy Anglo. And they're like, yay, copper. And they're like, no, we're buying another copper mine. Oh,
Yeah.
never know what's happening. But apparently, copper's a hugely popular thing.
Well, I mean, the charts are saying there is demand, though. This is a huge band that's been trading in, between that 11,100 and 6,900. So, just judging from this, it's pulling back. Of course, it was extremely overbought, but it may just hold at that 8,860 mark and then continue with its uptrend. It's on an uptrend. It's just a correction within the bull trend that's happening. One would say this is probably the best time to start buying because you'll be buying at the low because it always kind of bounces on that support trend line. So these are good buying levels for potential. And this could also be seen as a wedge or a flat, well, not necessarily a flat, but a wedge of some sort. So this could be the time to buy with a stop loss still kind of being slightly below this level just in case it breaches. But this has held since 2020.
It's Simon's favorite chart. It starts on the bottom left of the screen and goes to the top right of the screen. And it looks good. It really does.
The copper story is, so it's EVs, but it's also electrification. And I forget the number, but like the world has to spend about a couple of $1 trillion on electrification. And that's not just renewable, which it is in part. It's also, I mean, we talk about our Eskom fleet is old. Electrical fleets the world over are old. Data centers consume huge amounts. I mean, Microsoft wants to put small little pebble bed nuclear power plants next to their data centers. This is all about copper. Copper and copper is your best conductor of electricity. That's just the periodic table. You can't argue with that.
Do you know what's interesting about the copper space for me is I see the levels, I see the uptrend and all of that, but copper's almost 90% reusable. So
Correct.
For something that,
For a lot of things.
right, and for something that has more use than a gold or something else, a gold you melt down or whatever, you put it into a finished product, it is what it is. You can recycle copper, almost all of it, and yet the price is still very much evident of the fact that it's in demand. There is a lot of, but it speaks to
Undervalued
your point.
Compared to gold.
It is. It speaks to your point, Sai, about the fact that there's that much of it that's in use or that's in demand that even at $8,000 a ton, it is something people are willing to go into.
And the recyclability. I mean, the point is that, Kuberg has got, I don't know how many tons of copper, and that thing's been there since the 70s. So it's recyclable. But when it goes into a vehicle, which is a modest amount, it's there and it can get recycled and maybe within a decade or two. Maybe the same with chips. But in terms of electrical supply, it goes into the ground, it goes in, and it is now there for decades and decades. There was a time when I ran the numbers and Telkom's holding of their copper was worth more than the market cap of the company. The trick was pulling those cables out of the ground one by one. But yeah. So it is infinitely that stainless steel. I mean, stainless steel even more, which is chrome. Which is the PGM guys are suddenly all excited about chrome.
Well, everybody seems to be optimistic about this Transnet getting their ducks in a row. I remember chatting to Oslo Mittal this week as well. Their CEO said that they were optimistic as well that Transnet had finally figured out their lives and things were going to go back to some form of normal. But that's for South African miners, and that's a story for another day because unfortunately we've run out of time. This is always the problem with our segment is we never have enough time. Moxima, thank you so much for coming through and for joining us. We're definitely going to have you back on because we like the pictures. The pictures look very pretty. There's a lot to go on here. But that's all we have time for this week. Let's get into investor insights.
Yes, please.
What does this week look like?
All right, so last week I had alluded to speaking about default retirement options for employer groups. I do not know whether, and just coming from the conversation about women, right? And having to relook at how we give women advice in terms of their retirement planning. Should we leave it to trustees to make that decision? And for me, the reason why I'm asking this is I feel like it's such a difficult decision considering the fact that you're not always going to know the makeup of your staff to be able to considerably look at a default option for the entire employer group that makes sense for each and every single individual there.
Yes, but
There's
need the
always,
but.
no. There's always a but. Go for
so
it.
I mean, it depends. So by default, I mean, and I haven't worked in a corporate for a while, but my default options there were three, and it was basically high, moderate, and low risk. And I think the default there was actually moderate, if our memory serves correct. The point is, if you are anything under 65 or 75 years old, you should just be in high risk. You should just be in high risk because you have time on your side. And I know folks are like, oh, I'm retiring at 65. But you're retiring at 65, but you're living
live to 95.
So you've still got 30 years. So at some point you want to start de-risking it. But if you are working, you do not, I mean, maybe as you get a little bit closer, maybe 5 or 10 years out, you want to drop it into the moderate. You never want to be in the low risk unless,
Absolutely.
you know, and you basically, you want to be in high risk. You want that volatility. You want the horrible experiences of market crashes because you get the flip side, which is these crazy rallies that markets typically go higher.
So the interesting thing, and I think this is probably where the question is coming from, Nicolette, as well, is this kind of information was never really out there for us, right? So if you haven't worked in financial services and you haven't got that knowledge, it's difficult to comprehend this. When someone says high risk, you think I'm going to lose all my money. And that's because there have been bad apples that have operated in this space that have taken people's money and done things they shouldn't have, or people that have over leveraged or overexposed and that sort of thing. So Simon's point around high risk is to say there's a certain level of volatility or there's a certain level of movement in the market where the risk is justified because the reward offsets it.
Absolutely.
And that's something that we have to first of all comprehend and understand. But when you think about your portfolio, I think another part of it was if we set your portfolio to low risk, I as an asset manager with an asset management license don't need to do much.
Yes.
If my benchmark
passive.
my benchmark that I need to beat is 1.5%, and I annually do 2.5% to 3%. 1, I've beat benchmark. 2, I get to charge you the 2.5%. 3, I don't have to do any of the work. So it's kind of an environment where it's not. And for me, as someone that's been stepping into asset management from an alternative asset point of view, it's been frustrating to say, guys, we should be, as asset managers, as an industry, we should be offering and generating more returns than what we're generating for clients. Yet we sit back and you look at the benchmarks and you look at the top 40 doing 6% or 5% for the year, and then an asset manager will do 6.5%, and you say, guys, just put the money in a fixed deposit. Then you're not actually the whole
Doing any
point
actual-
of right. And this is where it comes back to what you're suggesting around the portfolios and everything. The reality is we could have a lot better in terms of performances for these portfolios and the performances in general or the returns in general, and that would last a lot longer into retirement. There's a risk-averse approach from the asset management side of it. There's a risk-averse approach that is conditioned into the client to say, don't take risk. Risk is bad. Risk is not for you. It's only for you until you are 30 or until you have children. Now, as asset managers and as trustees, which comes back to your question, those trustees are trained. We'd like to think.
I was about to say.
Well, trained might be doing some heavy lifting in that sentence.
Your job is to manage risk.
But isn't it partly also the language? To your point, around high risk. Shouldn't we? So there was a thing which I stumbled across about 10 or 15 years ago that I loved, but it never took off. It was term date product. So you're in a fund that is for 35, and that's when you turn 65. In other words, your retirement date matches with the fund. So we don't call it high risk, low risk, offshore, local. We just know that you want this
fixed
money.
term contract. At that time, you are out.
And you want your money on this date.
Yes.
So between now and then, don't stress it. We will glide you out. Now, there's always a risk they'll take you too low risk when you get near retirement. But that sort of thing, to remove away the language, which is scary. Because which person in their right mind...
It's going to go high risk.
Yeah, well, you think of a young single mom joining a big corporate, nice fancy job. High risk? No.
Absolutely
But
no.
I've got children, I've got responsibilities.
But
I
that's
want
the
low
wiring,
risk.
right? That's the wiring that's
Correct.
been conditioned in the language that you're saying, is that we've been predisposed to say that is bad.
Yes, high
That
risk
is
bad.
a no-no.
Yes, yes.
And when you think about what high risk could potentially mean, it could mean that your portfolio, instead of going at a risk percentage of 10%, we're now risking at 20%, which is twice what it would have been. But your return profile, instead of aiming to return 30%, we're now aiming to return 60%.
60%, yeah.
How much more of a difference does that make when we look at your retirement in the long term? And as I said, you don't have to be high risk your entire life. You can be high
Kind of
risk
put
for
it in
20
life
years
stages,
of the
yeah.
life, but there must be a time in life. And it's easy to say be high risk in your 20s or in your 30s when you've got nothing to lose.
So here's my take, right? I retirement fund providers obviously do not like me much because I always say you don't need a retirement fund, you need funds in retirement, which ultimately it's got to have a makeup of some
You need
retirement
the
fund.
money.
So could we help then people then, and I guess this is what this segment is all about, is to try and offset the ordinary person, that if you are going to find yourself in a low risk default option in your retirement, then on the other side, follow what we're trying to teach you, right? In terms of then you're putting together your own individual investment portfolio. And I guess there's an opportunity for us to then teach about the risk and reward relationship.
I think we're seeing that more. I think we're seeing that more emerge in the generational or the age differences, right? So I look at my setup and in my personal journey in finance, and I look at the journey that my mother went through, and I use my mother as an example because she's a civil servant, which
Yes.
means her funds are sitting with the PIC,
Yes.
which means they're being invested by the Public Investment Corporation. Some of the decisions they've made, I would have never made. I don't agree with.
Yes.
We can't be putting 4.3 billion rand into companies and then being told you can't get that money out. You know what I mean? That's a material number. But I think we're also coming into the phase where, and I remember the example I used, I think it was a couple of episodes ago, where I said a friend of mine is starting a property portfolio, and
Yes,
he's
yes, and
understanding
he's
leverage
gearing,
and he's
yes.
gearing one property into the other.
Yes.
I think we're going into that phase where you're starting to make more conscious decisions because you're doing your own research, because information is out there, and we can do our part. I mean, we can help with providing that information where we can, but I definitely think the landscape is changing, and you're also it's not just South Africa, you're seeing it in America as well, where and the whole world, in fact, where Gen Zs are saying, I'm not going to save for retirement, I'm going to live for experiences, and I'm going to live my life for the things I can control now. And if I'm going to invest in property, or if I'm going to invest in things, I'm going to invest in things I understand and things I believe in. And that poses quite an interesting challenge to the retirement funds. I mean, yes, they'll still have the corporate businesses they can go into and get corporate clients and that sort of thing. But more and more people are becoming aware.
And managing their own. You've got your retirement fund, which is going to be boring and Reg 28 and all of that, and have hundreds and thousands of stocks and bonds and stuff. And then you're going to open yourself a brokerage account. And assuming you're not, there's ETFs and tax-free, as soon as you go and venture and buy an equity, you are now getting a pointy high-risk area, because you just, as an individual, you can't manage that level of risk. You can't have, in my equity portfolio, if I have 15 stocks, I think I've got too many. It's highly concentrated. So maybe my risk comes from my self-managed portfolio. Now, again, back to the question and back to the debate from 2 weeks ago, men versus women.
Yes.
Women go for ETFs because they are risk averse
Yes.
for all, bunches of reasons. So then they don't get the growth in their money, and then they live longer.
But they're taking the first step in self-managing, right?
Yeah, sure.
Because that self-management part of it is so important, Si, as you say, because there's a part of it, and we spoke about this when we spoke about the trustee part of it. There's a
Yes.
part of it where you say, I don't want to think about some of the decisions because I've got other things on my plate.
Yes.
But then there's also a part where you say, do you know what? Maybe I can have a little fun. Maybe I can learn about this. Maybe I can
Yes.
grow here, here, and here. And you start a side hustle. You start a bakery. You start an in-home business. You go out and that is diversifying your portfolio.
Absolutely.
It doesn't have to be diversification across the asset classes that we know and love. Diversification can come in many forms.
Yeah, and that's your point. You don't want a retirement fund. You want funds at retirement.
Absolutely. So the next one that I want to talk a little bit about, it came out quite a number of months ago, OpenAI partnering with Apple. So, first and foremost, it gives OpenAI access to, I do not know how many handsets and how many
About a
laptops.
billion. About
a billion. And that's quite enormous, right? Then I think last week or this week, they've come out to say they are launching their own search functionality, which is obviously going to now rival Google. What are your thoughts on that? I just want to get a sense of where are we going? Do you think Google is still going to have a place in this market?
Absolutely.
Why? Why do you think that?
Think about Microsoft Linux. Think about Apple, Samsung. Think about, there's always going to be competition. There's always going to be a challenger for the top spot. But look at how Google has completely dominated Yahoo, MSN, Bing, and everything else that has come before it. It is a behemoth of a business. They are on every device. The only thing that Google misstepped on, and this is my only criticism towards that business, was wanting to make it mandatory for all Android devices to be by default on Google. That was what sparked this whole thing, this whole row about wanting to find alternatives, right? There was a time where Google said, if it's an Android device, the only search engine or the first search engine must be Google. You can't have an open sourced software or an open platform where people can make their own choices and then want to dictate what those choices should be. I welcome, and you both of you know my feelings on Apple.
That's why you're so passionate about
No, but I welcome this.
No, Dave, Google's going to be in the next 20 years.
No, I welcome competition. I don't have, as I said, I don't have anything, I don't hate Apple. Apple is not a bad product. It is an efficient product. It is remarkably efficient. And in that efficiency, to be able to expand that is the trick, is the challenge. Look at Apple's lack of innovation in the iPhone since Steve Jobs has passed away. From where it started to now the fact that the last 3 or 4 iPhones have looked pretty much the same, right? But if you can find a way, whether you're Tim Cook, whether whoever you are, to have your little ecosystem start to grow like this without jeopardizing the existing ecosystem, then you're doing something right.
So apparently it's actually 1.5 billion Apple devices. But that includes watches and TVs. But that means there's still 6.5 billion to go. I think Google has, it's a tough one. Have you been on Google search recently? It is a cluster nonsense of rubbish and ads and SEO.
Prioritizing revenues and other things.
Etc. It's just not a good experience. I mean, I use Anthropic, the Perplexity, for my search these days, which is Perplexity's an OpenAI competitor. Because I think Google's search in many ways is, and that is their crown jewel. It's 80% of their profits, but the search experience has gone so south. If you think back to the Google page of 20 years ago, which was nice and clean and simple, and now it's just this mess of chaos. And when I do click on a link, it's some server farm somewhere generating rubbish content.
But everybody's a threat to Google, because Google, as first mover, your thing is everybody can learn from the mistakes you made. Everybody has the advantage of your hindsight as their foresight. So they can sit there and say, okay, cool, these guys went wrong here. Right, so that's always going to be a threat that you face. It's about whether or not you've got a player that's brave enough to take it on, similarly to how we discussed the trade war and China being brave enough to take on the US. Apple is brave enough to take on Google, and they will. And how that ends, we will have to wait and see.
So Google search, 90% market share.
There we go.
So of course,
you have to have a challenger. You can't sit there and not expect anyone to show up to challenge that.
Yeah.
Are you buying Alphabet or not?
Here's a fun fact. So YouTube, in terms of revenue, is the size of Netflix. I mean, Google has Alphabet's got a little Netflix sitting in their in their hut that sort of no one even knows about. But they own search. They've got Android. They're in cloud along with AWS and Azure from Microsoft. And I would certainly not bet against them.
There we go.
So it's a buy.
It is a buy, but at the right price, I think.
I mean, a forward PE of about 21, which is about the lowest it's been in the last decade. I mean, I take your point, and certainly we're seeing tech selling. It might get cheaper. But I mean, I think at current valuations, I don't think Google is as expensive. I mean, if you compare it to Microsoft, if you compare it to Nvidia, heck, even just Apple. I mean, it's not a eye-wateringly expensive stock, but I do think you'll get it cheaper, perhaps as the tech
as the tech sell-off kind of happens. We're in a bit of a sell-off.
All right, so let's stay offshore and go BlackRock.
Ooh, the company that owns everything.
It owns literally everything.
No, they literally own absolutely everything. Now, Simon said you don't want to bet against Google. You don't want to bet against BlackRock. They own banks. And by banks, I mean like the size of JP Morgan. And BlackRock has its hands in everything. I'm going to pull up some of their investments and give you a sense of the magnitude of what we're dealing with.
The stock has momentum. It's been moving higher nicely since the bear market lows of 2022. It's also, as markets go up, these guys make more money because they charge a percentage, and therefore bull markets, these guys. So if we're heading into some struggles, they might struggle a bit. But let's roll forward 5 or 10 years. Markets are not at the same levels. They're higher. Just by dint of who they are, they have more profit and more money in the bank.
It's a buy?
Yeah, I'd like it. Here's what I didn't know, and maybe Anthropic is lying to me. They bought iShares from Barclays in 2009.
They own iShares, the brand.
Yes, you know the ETF issuer? iShares is BlackRock.
Yes.
They bought it from Barclays.
No, that makes sense, yeah.
They bought it, Barclays.
I didn't know that they bought it from Barclays.
I didn't know that either.
Wow.
Ooh, shame, poor Barclays. Barclays was probably going bust. It was 09.
All right, let's come back to South Africa. Famous brands.
They've been struggling along for quite a bit. They're at 54 Rand. I kind of like them at 50 Rand. I'm not against them at this price. I just think having spoken to some of the other CEOs, I'm probably going to lean more to someone like a Spur.
Yeah.
I like what Val's doing at Spur as the CEO. I love the fact that where they're sitting, one, the share price is cheaper than the famous brand share price, but two, most importantly, and this is so critical when we're dealing with companies in the retail space or in the restaurant space, Spur is debt-free. That's all I've got to say.
Yeah. Both give good dividends. Both own price earnings of about 12 times. Zero debt at Spur. Famous Brands are still paying off their disaster at Gourmet Burgers in the UK. But I was running the numbers. Assuming we get 2 rate cuts this year, September and November, 0.25% each, your average sort of family with a 2 or 3 million rand bond and 2 cars and all of that, they got $1,000 a month in their pocket back by December.
So more groceries, more eating out.
Yeah. Buy Famous Brands? Yes.
Yes.
Would I prefer Spur? Sure. But to answer the question...
So you can buy, we'll buy both?
Yes.
Yeah, all right. All right, but Spur's not on the table today, so put it on the side. Woolworths is my last one.
I've been in Woolworths.
I have been too. Operative there have.
I've loved Woolworths at anything between 55 and 60 Rand, and it's kind of below 60 Rand at the moment.
Yeah.
Bounced off 54 Rand. And the reason for that is there's this massive war in the supermarket space. You're not going to challenge a ShopRite. Please leave Peter Engelbrecht and his team alone. Those guys they're on mission take over the world. The share price clocked, they gave us 53-week updates now. The share price clocked 300 Rand for the first time in its history. It stayed above 300 Rand. And Pick n Pay is the other one, and Spar is the other one, and Spar's trying to recover from their SAP issues, and Pick n Pay's got its own life challenges. It is seeing a lot of flames, but Woolworths has stayed in their corner. Woolworths has been like, this is what we do it well, this is where we're going to sit. They finally got that David Jones monkey off their back.
But it's the doing well part I'm not so sure about. So the update from Spur
from ShopRite.
The update from ShopRite showed us quite clearly that their store growth, seems like for like sales, was below inflation, which means they're losing volume, whereas ShopRite is above inflation. The fashion, Woolies just can't get the fashion right. Again and again.
It's a difficult struggle.
It's a difficult struggle, unless you're Mr. Price, in which case it's the easiest thing in the world. And I mean, buy Woolies? No. Buy ShopRite.
So we've spoken about this before, right?
Yes.
ShopRite at 300 Rand looks expensive in the South African context.
Okay.
But ShopRite, when compared to its global counterparts, and Sai will pull up the PE numbers about it, we've looked specifically at ShopRite versus a Target or a Walmart or something where they compete because they compete realistically at that scale with the value chain that they've got. If you're measuring them against their global peers, it's the cheapest stock you can buy.
And let's be clear, if you measure it against its global peers, it's also the most profitable. Of
Yes.
all supermarkets with more than 1,000
Yes.
chains, they have a higher operating margin. The mean is about 2.5%. ShopRite rocks at 6, 5.5, 6.
this
they
week-
obliterate the world.
This week of picks is a week of you don't want to bet against these guys. ShopRite's another one.
Is that the theme?
ShopRite's another one. Yes.
And ShopRite on a forward PE is average priced even at $300.
So, okay, all right. I think we'll leave it there. I'll throw forward to next week. I want to talk a little bit about the franchise model, if it's something worth investing in. I think we've seen some South African entrepreneurs start their thing in South Africa, don't go the franchise model. It seems to work for some of them. Obviously, we don't have the intricate numbers there, but we've also seen it work for others. But we've also heard about exploitation within the franchise model.
And you've seen guys that have built franchises and scaled too quickly.
Yes.
And it's gone pear-shaped.
Yes.
So
yes,
definitely
yes,
worth
yes.
looking into. I think there's a lot to unpack there.
Oh, and happy Women's Month, guys.
Happy Women's Month.
Thanks, guys.
And on that note, we'll leave it at that. Remember to follow us on our pages. We are on all our socials. We're on YouTube, we're on Twitter, we're on X, we're on every social we can think of. The podcast is available everywhere. So you really can't say we haven't put it out there for you. Until next time, investing isn't hard.
Just try it.
There we go.